Welcome to the deep dive. Today, we're jumping into the fascinating world of algorithmic trading, where computers are making the calls.
And specifically, we're looking at a really critical process called backtesting. It's fundamental.
Our insights today, they come primarily from Faida Ventures LTD. They're quite focused on automated trading systems and, importantly, rigorous testing.
Right. And our mission today really is to help you get a clear handle on what backtesting involves, how it works, why it's done, and maybe most importantly, what it can't do.
Think of it as your shortcut, your inside look at how these complex trading ideas get vetted before, real money is on the line.
Exactly. It's about bridging that gap between theory and potential practice.
Okay, so let's start right there, the basics. What exactly is backtesting when we talk about trading algorithms?
Well, at its core, backtesting is essentially checking how a trading strategy would have performed if you'd run it in the past.
So using historical market data.
Precisely. You take your algorithm, your set of rules, and you apply it to months, maybe years, of past market data to see the outcome.
Like a historical simulation, running it through past market conditions to see what happens.
That's a great way to put it. It's that crucial first step from just having an idea on paper to seeing if it has any, well, potential legs in the real world. Faida Ventures really stresses this part.
And why is that so important? Why put these strategies through this historical workout? What do you actually learn?
Well, there are two main things, really. First up is performance assessment.
Okay.
Backtesting gives you a feel for the strategy's potential profitability. You can look at things like win rates, how big the average losing trade is versus the average winner, your risk-reward ratio, and the overall hypothetical profit over time.
So it helps you judge if the algorithm looks like it might actually make money or if it's potentially flawed from the start.
That's the idea. And second, just as critical, is risk management validation.
Okay. Checking the safety features.
Exactly. You can test things like your stop-loss points, where you cut your losses, or how much money you allocate to each trade, your position sizing. You see if those rules would have protected your capital during, say, difficult market periods in the past.
Right.
Faida Ventures, for instance, they use this to ensure their strategies aren't just aiming for profit, but are built to manage risk effectively. Right. Minimize downside.
Makes sense.
Yeah.
You're not just looking for the home runs, but also checking if the defense holds up when things go wrong. Okay, so how is it actually done? What are the steps to run a backtest?
Generally, you can break it down into about 4 key stages. First is data selection.
Getting the history right.
Yes. You need to pick the historical data that's actually relevant to your strategy. That's usually price history, of course, but maybe also market indicators or even things like news sentiment data, depending on the algorithm.
And I imagine the quality of that data is everything. Garbage in, garbage out. Right.
Absolutely paramount. If your data is bad, inaccurate, missing chunks, errors, your backtest results are basically useless, worse than useless, actually, because they could give you false confidence.
Okay, point taken. Data quality is king. What's next after you've got good data?
Then comes strategy definition. This is where you lay out the precise rules for your algorithm.
The actual instructions.
Exactly. What triggers a buy? What triggers a sell? At what price points do you enter or exit? What time frames are you looking at? Your money management rules, too. It all needs to be defined crystal clear.
So, like, buy when this moving average crosses that one, but spelled out completely.
Precisely. No ambiguity allowed. The computer needs exact instructions. Then, step 3 is actually running the backtest.
Firing up the simulation.
Right. You use specialized software platforms for this. These platforms take your data, your rules, and they simulate the trades over the historical period, trying to mimic how it would have played out in the market.
Okay, so the software acts like a kind of financial time machine, applying my rules to past events.
That's a good analogy, yes. It crunches through the data, executes virtual trades based on your rules, and logs everything: profits, losses, timing.
And then the final step.
That would be results analysis. Once the simulation is done, you get a report, essentially. You need to dig into it, look at the total return, sure, but also the drawdowns.
Drawdowns, explain that a bit.
Think of your account balance over time like a graph. A drawdown is the drop from a peak in that balance down to a subsequent low point before it recovers. You want to know how big those drops were historically?
Okay. The painful dips.
Right. You also look at trade frequency, consistency, things like that. And this is where metrics like the Sharpe ratio come in.
You mentioned that earlier. What does the Sharpe ratio tell you specifically?
It's a measure of risk-adjusted return. Basically, it asks, for the amount of risk or volatility you experienced, was the return you got actually worth it? A higher Sharpe ratio is generally better more return for the risk taken.
Got it. Okay, so backtesting seems like a really powerful approach. It sounds almost like predicting the future by studying the past very carefully.
Well, that's the tempting way to see it, but that's also where we need to be really careful. Backtesting gives valuable clues, definitely, but it's not a crystal ball. It has some pretty significant limitations.
Okay, let's hear them. What are the big caveats? The potential pitfalls?
Probably the biggest danger is something called overfitting.
Overfitting.
Yeah, this happens when you tweak your strategy so much based on the specific historical data you used that it looks absolutely amazing on that data, but it's actually too perfectly tailored to the past.
So it won't work going forward.
It's much less likely to. It hasn't learned general principles. It's just memorized the answers to one specific historical test. It lacks robustness for new, unseen market conditions.
Like cramming for one specific exam and then finding the real test asks different questions.
Exactly that. You need to optimize, sure, but you have to avoid optimizing so much that the strategy only works on that one historical data set. It's a tricky balance.
Okay, overfitting is a major risk. What else?
Another huge one. Market conditions change. Financial markets aren't static, they evolve.
Constantly.
Right? New regulations pop up, different players enter the market, the whole economic backdrop shifts. What worked brilliantly 5 years ago might be completely ineffective today because the underlying game has changed.
And backtesting can't predict those future changes.
Nope, it's inherently backward-looking. It also can't really account for those sudden, unexpected shocks, black swan events that can just rewrite the rules overnight.
That makes sense. The past isn't always a perfect guide to the future, especially in finance. Any other key limitations?
Yes, the practicalities of execution. Backtests often assume perfect trade execution.
Meaning you get the exact price you aimed for?
Pretty much.
Yeah.
But in reality, you deal with slippage. That's the small difference between the price you expected and the price you actually got filled at. It happens, especially in fast markets.
And that can chip away at profits.
It certainly can. And related to that is liquidity. Your backtest might assume you can easily buy or sell large amounts without moving the price. In reality, especially for less traded assets or large orders, your own trading can impact the price you get. Backtests often don't fully capture these real-world frictions.
Right. The simulation might be too clean compared to the messy reality of live trading.
That's a good way to put it.
Okay, so you've done your backtest. You're aware of the limitations like overfitting and market changes, and the results still look promising. What's the smart way to move forward? How do you bridge that gap to actually using it?
You absolutely need a gradual, cautious transition. Faida Ventures really highlights this. The very next step after backtesting shouldn't be live trading with real money. It should be paper trading.
Demo trading, using fake money.
Exactly. You run your algorithm in the live market in real time, but with a simulated account. No actual capital is at risk.
Why is that step so crucial?
Because it tests your strategy against current market conditions with live data feeds. You see how it behaves right now. Identify potential glitches, see if the real-time performance aligns with the backtest, all without risking a penny.
It's like the final dress rehearsal before the actual performance.
That's a perfect analogy. Then, if it performs well consistently in paper trading, you move to gradual live deployment.
Okay, so dipping a toe in.
Precisely. Start small. Allocate a small amount of real capital. See how it performs. If it continues to meet expectations, you can slowly increase the capital allocated to it. You don't just flip a switch and go all in.
Testing the waters with real money, but very carefully.
Yes. And the final piece, which never really ends, is continuous performance monitoring.
It's not set it and forget it.
Absolutely not. Markets change, remember. So even a strategy that works well initially needs constant watching. You track its live performance, compare it back to your expectations and your backtest results. You need to be ready to tweak it or even turn it off if it starts to degrade or if market conditions fundamentally shift.
So ongoing vigilance is key.
Non-stop, really.
Yeah.
Algorithmic trading requires it.
Okay, let's try and wrap this up. What are the main things you want people to take away from this deep dive on backtesting?
I think the key is understanding the balance. Backtesting is essential. It's your primary tool for getting an initial read on a strategy's potential using historical data, for checking performance and risk. It's indispensable. But you absolutely have to understand its limits. Overfitting is a real danger. Markets change, making past results an imperfect guide. And the simulation isn't the same as live trading reality.
So the transition needs care.
Exactly. That careful step-by-step move from backtest through paper trading to gradual live deployment, followed by constant monitoring, that's critical for actually succeeding.
Right. So backtesting gives you valuable clues, maybe even essential ones, but it's just the starting point. Real-world performance, careful risk management, and adapting over time, that's what ultimately matters.
Couldn't have said it better myself.
Okay, so here's something to think about as we close. Given all these limitations we've talked about, overfitting, changing markets, execution issues, what else, beyond just the historical data patterns, should someone really dig into before they trust a training algorithm with their actual capital? Something to ponder. Thanks for joining us for this deep dive.